Okay, let's dive right in. Today, we're taking the dense, highly technical rules of IAS 16 and translating them into a dynamic, rule-based playbook that you can actually use in practice. Look, if you're a practitioner, you already know that accounting for fixed assets is way more than just filing away receipts, right? It is absolutely crucial because it's about strictly policing what gets to sit on your balance sheet and what hits your profit and loss statement. So, throughout this explainer, we are going to break down the exact logic flows, the key policy choices, and those tricky exceptions that you literally have to master to get this standard right. So, here is our topic guide for today's explainer. We'll be looking at objective and scope, definitions, recognition, measurement at both recognition and after recognition, derecognition, and finally, disclosure. Think of this list as your ultimate checklist. Treat this as your minimum coverage requirement to ensure absolutely nothing slips through the cracks.
All right, let's kick things off with Section 1, Scope, Objective, and Recognition.
The fundamental objective of IAS 16 is pretty straightforward. It's to give users of your financial statements a crystal clear picture of your company's investment in property, plant, and equipment. Now, this applies to almost all tangible assets, unless, of course, another standard claims them first, like, say, assets explicitly held for sale under IFRS 5, or biological agricultural assets, like a herd of livestock. But generally, if you plan to use a tangible asset for more than one period, whether that's to produce goods, rent out to others, or just run your admin, it falls squarely in our crosshairs today. Now, you don't just capitalize a cost because the invoice was massive. Every single cost has to pass some very strict recognition gates. So if it's probable that future economic benefits will flow to you, and if you can measure that cost reliably, then boom, you recognize it as an asset. Notice the strict boundaries here. If you're just doing day-to-day servicing, swapping out small consumables or changing the oil, that goes straight to your profit and loss statement as a repair expense. No exceptions. But if you're replacing something huge, like a massive aircraft engine, then you capitalize that new cost. And this is just as important, you have to de-recognize the remaining value of the old one. And this actually brings us to a major area of estimation uncertainty. The standard doesn't hand you an exact unit of measure. Individually, having thousands of wrenches or small manufacturing molds might not really seem like capital assets, but when you look at them as an aggregate, that's a massive economic resource. This is where your professional judgment comes in. You have to decide when it makes sense to group smaller tools together and apply those strict recognition criteria to their combined value. Okay, moving right along to Section 2, Initial Measurement Rules. Let's see how we value these assets on day one. So the primary measurement basis here is actually pretty simple. If an item qualifies for recognition, it shall be measured at its cost. But you've got to draw a really hard line on what exactly constitutes cost. Direct physical readiness is included. Think purchase price, non-refundable taxes, site prep, installation fees, all of that is in. But your operational business expenses, those are strictly excluded. You absolutely cannot capitalize the cost of opening a new facility, throwing a massive launch party, general admin, or sending your staff to a training seminar to learn how to use the new machinery. Let's make this concrete. Walk through this timeline with me. Imagine you're installing a custom robotics assembly line. You buy the hardware and pay the import duties. Included. You pay structural engineers to get the site ready. Included. But here is the critical pivot point. The absolute moment that asset is physically capable of operating exactly as management intended, the asset cost is locked. So later on, when you send your operators to a 2-week training boot camp, or you run an initial loss while you're figuring out the optimal factory speed, all excluded, expensed immediately. Those are the realities of running a business, not the cost of the asset itself. Now keep a really close eye out for this policy choice when you're structuring a purchase. If you manage to secure deferred payment terms that stretch way beyond normal credit, you have a specific choice to make. You must record the difference between the cash price equivalent and your total payment as interest, unless you proactively choose to capitalize that interest into the cost of the asset, following the strict borrowing rules of IAS 23. It's a deliberate policy lever, so be aware of it. All right, Section 3, Subsequent Measurement Models. What happens after day one? This right here is a massive fork in the road. For subsequent measurement, you have to choose either the cost model or the revaluation model. But here's the catch, and it's a big one. You cannot cherry-pick individual assets just to make your balance sheet look a little prettier. Whatever model you choose, you have to apply it to an entire class of assets, so all your land or all your motor vehicles. This prevents a messy, misleading Frankenstein mixture of historical costs and current values.
When you're mapping out this subsequent measurement, you really need to track the exact destinations of your numbers. It's like a logic puzzle. If the cost model applies, it's straightforward, carry at cost minus depreciation. Where does it go? The asset drops on your balance sheet and the depreciation hits your P&L. Simple. But if the revaluation model applies, it gets a bit nuanced. If fair value increases, it flows straight to other comprehensive income, OCI, and sits safely in equity. If it decreases, it generally hits the P&L. And if an increase actually reverses a previous P&L decrease, well, then that specific portion goes back through the P&L. You've got to track these flows flawlessly.
Moving into Section 4, Impairment and Derecognition. So every asset eventually leaves the balance sheet, right? A truly critical rule in IAS 16 is that you have to treat impairments, third-party compensation, like an insurance payout for a fire, and the subsequent replacement of that asset as three entirely separate economic events. Do not just net them all together into one messy journal entry. Treat each phase of this life cycle independently. And remember, derecognition isn't just for when you sell a whole factory. It applies all the way down to the component level. If the asset is disposed of, derecognize it. If it's completely destroyed and there's no future economic benefit, derecognize it. And critically, if you perform a mandatory major inspection, you must flush out the carrying amount of the old inspection. Seriously, you cannot leave ghost assets inflating your balance sheet. Now, the standard enforces a really strict prohibition here. When you dispose of an asset, yes, you can absolutely recognize a gain on disposal in your P&L. However, you shall not artificially inflate your top-line revenue with it. It is a disposal gain, pure and simple, not revenue from your core operations.
Let's tackle Section 5, Exceptions, Limitations, and Prohibitions.
Please, whatever you do not bury these exceptions. For instance, except when your company routinely rents out heavy machinery and then sells it. In that very specific case, IAS 16 forces you to transfer those assets into inventory first. Also, unless a property is owner-occupied but measured using the IAS 40 investment property fair value model, you've got to treat it as an entirely separate class. And, again, repeating for emphasis because it's that important, you shall not capitalize daily servicing, and you shall not call disposal gains revenue. Now, accounting standards do not live in a vacuum. They talk to each other. You need to know exactly how IAS 16 plays with the rest of the rulebook. For example, it gets overridden by IAS 2 for inventories when you're dealing with those former rental assets. It completely supplements and relies on IAS 36 to figure out impairment losses. It's used right alongside IAS 37 to measure your liability if you have to eventually tear down a site. And crucially, it defers to IFRS 16 when you start getting into complex sale and leaseback transactions. All right, we are in the home stretch, Section 6, Disclosures and Common Errors. When you're putting together your disclosures, you have to explicitly separate the numbers from the narrative. On the quantitative side, you have to show the roll forward, the gross carrying amount and accumulated depreciation from the beginning of the year all the way to the end. But qualitatively, you've got to explain the how and the why. What were your measurement bases? What depreciation methods did you use? And if you use useful lives, then you must disclose exactly what those are so investors reading the statements can judge for themselves if you're being overly aggressive or properly conservative. Okay, let's look at the 3 most frequent mistakes practitioners make out in the wild. Mistake number 1, capitalizing staff training or marketing costs. Correct this by rigidly separating capital expenditures required to make the asset physically function from your everyday operational expenses. Mistake number 2, leaving ghost inspections on the books. Correct this by making sure you actively derecognize the old part when the new one is installed. And mistake number 3, inflating revenue with disposal gains. Again, correct this by keeping those gains firmly below the operating revenue line in your P&L. I want you to really think about that question the next time you analyze a company's fixed assets. When you look at that massive property, plant, and equipment number, are you seeing the true economic engine of the business? Or are you just seeing a reflection of the specific policy choices and estimations that management decided to follow? Understanding the strict rules of IAS 16 is literally the only way to peel back those layers and see the reality of an entity's true operational capacity. Keep questioning the numbers and keep learning.